But I think, between a gold mine, with 2 grams a ton in Ghana and one with 20 grams a ton in Burkina Faso, you're probably still going to go for the one in Ghana just because of the political risks.
Alrighty. Shitload happening today.
There's a bit, mate. Oh,
Travis Ricciardo. There is a heap happening around the mining world today.
mate, there's a lot. The Reko Diq in Arizona is ratcheting up. There's uranium mines being expropriated by African governments. Barrick is continuing to be marred by its challenges, and it's hated by the market for being a worse performer than gold. Plus,
And
Tim Staermose, mate, he is an African investor, and I had the privilege of speaking to him earlier. We're going to play his insights on what it's like to invest in Africa, what you need to know about the various countries, their appetite for capital, and the risks that you face. Can't wait to play that.
That was a wicked chat. I'm really excited to share that one because people often paint the whole continent with the same brush, and it's not justified. So it was awesome to hear, mate. But there's a heap of stuff going on in the market that we just don't have the time to talk about. But raisings at Develop, Bannerman, to name a couple.
Big raises. Develops $180 million. Bannerman's was a chunky size.
Yep, $85 from them. Snowline, they came out with their PEA numbers, which were pretty chunky. Emerald hit a snag, and Hope Downs, but Rio Hancock announcing a big investment. So
Not to mention
happening.
Greatland's debuting on the ASX today.
They are.
That's been a long-awaited debut. Mate, there's just a bunch going on, and we've probably missed half of the things going on. All the gold raises recently too. Anyway.
Start us off, mate. Reko Diq. We're going back.
The Reko Diq in Arizona is heating up even more, JD. This deal has my bandwidth. I'm loving it. And we've now got confirmation that it's properly competitive because Kinterra has submitted a bid themselves at 5.7 cents. Where we left off on Friday, CAML, they had upped their bid twice in the same day and snagged themselves a 5% stake in the company. The original deal was 5 cents, right? That's what was agreed. The first upwards revision revealed Friday morning, 5.3 cents. And then by Friday evening, it's already 5.5 cents. CAML, all three of those, right? So of course, yesterday when Monday market open comes around, my eyes glued to the screen to see what the latest development would be on the Reko Diq in Arizona. And I wasn't disappointed, JD, because it quickly became apparent that Kinterra, the private equity group, they had been working hard over the weekend. Kinterra managed to strike a deal with RCF, who, when you look at the public data that's available, it appeared like RCF was the only substantial shareholder other than the two bidders in the race here. RCF, they had a 7.4% stake in the ordinary shares of the company. That's 256 million shares. But also in their name were 62 million oppies. These were already in the money because they had an exercise price of 4 cents. So, certainly a decent stake when you put it all together. And also where we left off on Friday, because it turned out that it was CAML that scooped up the 5% block trade at 5.5 cents, it meant that Kinterra likely still only had 12% of the company themselves, but they were clearly keen to build that to a higher stake to have more influence.
So they did a bit of work over the weekend.
They struck a deal with RCF, mate, for the entire holding of RCFs, all the shares, all the options. They paid 5.6 cents for the shares each and 1.6 cents for the options each. And you're probably thinking, why on earth would RCF be willing to part ways with its stake when this is a competitive situation? Why? You're giving it away, but you're not getting the upside of it. Well, excellent question, JD. And I know you were thinking of it because if you read the sale deed signed between RCF and Kinterra, you'll see that RCF sold their stake. But for all intents and purposes, if there's any deal uplift from where they sold out, they still get paid and they get to keep 100% of that uplift, not 50%, like we've seen more commonly. Like think when Capital Drilling was, they sold out of their predictive stake to Perseus.
Perseus, yeah.
So they would share 50% of an uplift if a change of control happened in the next 12 months from memory.
Don't you wish you could just have them when you offload your shares? Like, there.
Yeah.
Love to partake in the upside.
Yeah, I'm happy to sell them to you just as long as I get all of the upside that comes from this competitive situation.
You take the downside, though. That's all good.
Yeah. And, RCF, 100% of the upside, the entire upside.
So Kinterra get their fill. They sit at a bit over 19% of New World. They then lob a bid, mate.
They do, mate. We learned this pretty quickly Monday morning too. First, the story appears in Street Talk. They reveal that Kinterra has privately lobbed a bid to the board of New World at 5.7 cents per share. And this leak warrants an announcement out of New World Resources themselves. In this brief release, what they say is that New World confirms it received an unsolicited, non-binding, conditional and indicative proposal from Kinterra Capital. The indicative proposal is incomplete and subject to a number of conditions, and their board is in the process of reviewing the proposal. So I read this and I'm just thinking, mate, hallelujah. Like this is officially a public bidding war now. Like a bidding war. It's beautiful. These don't come around every day. And before I get too carried away, there's a few caveats that are sort of necessary. So Kinterra's offer is conditional, right? You can see that in the wording, unsolicited, conditional. So we don't know what these conditions are that have been presented to the board, or if the conditionality in their offer is of comparable conditionality to what has already been agreed in the CAML offer, and that conditionality can matter a bit here, but this is a bidding war. Like now we see New World stock trading a tad north of Kinterra's offer price already. Like if you look at the volume that transacted today, like shares are trading at 5.8 cents. Kinterra's conditional bid that it's just an indicative proposal put to the board, that's 5.7 cents.
Market's getting excited, mate.
Yep.
So what's next?
Well, I'm excited. What's next? Well,
Who isn't?
the New World board, they have to determine whether this Kinterra offer is capable of becoming a superior offer or not. And I think the answer to this question is going to prove to be yes.
And of course, we've got the placement still hanging in the background from Friday.
Now, remember that placement was conditional on no other offer received within 14 days that is deemed to be capable of becoming a superior offer. So at which point, when this offer from Kinterra gets deemed to be capable of becoming superior, well, that placement falls away, right? Because it was conditional. And hence, the takeovers panel proceedings will also fall away. So just put all of that to bed now. And when the answer to all of this is yes, then remember CAML, they have a matching right as part of the scheme implementation deed. And in effect, what does all that mean? It means that we get to find out the answer to the question, who wants this more? Who is willing to pay more, CAML or Kinterra? That's ultimately where this is right now. Like assuming the conditionality penned to the board in the Kinterra offer is of similar conditionality to CAML's agreement, then we get to be like people in the crowd at a home auction, and there's two bidders left, right? And they get to keep on going higher and higher until one of them says, too much. You have it, mate. Like I can't justify this price. And all of this to the benefit of the homeowners at that home auction, JD, or in this case, the New World Resources shareholders, all to the benefit of them. I'm so pumped.
Having a win. Yeah, it's such an interesting dynamic seeing a private equity group go head to head against a miner. Have you got a favourite, mate?
I don't have a favourite because I'm just like not familiar with the bidders very well. But I do actually think I'd rather be like if I was completely indiscriminate about price and I didn't care about price paid, who do I think has a better chance here? I actually think that even though like CAML's got deal protection and a matching right and a signed and agreed scheme implementation deed, I think the 19% stake that Kinterra has is actually more influential here. So I think that kind of matters more. If they both have similar levels of insensitivity to price, like I'd rather be Kinterra.
Yeah. If you're as in the weeds on this one as we are, mate, the two founders of Kinterra did a potty not too long ago. You can just search their names, so check it out, or in yesterday's director special if you want to get a bit of a flavour for what their approach to owning these assets is like.
Cheryl, Kamal, if you want to come on the podcast and be part of the rack attack in Arizona, we'll have you on. And same to anyone at CAML.
Yeah.
Yeah.
Microphone is free.
Same to Nick Woolrich. Would we have him on to try and solicit the best offer? That'd be pretty funny.
Get a third party involved.
Yeah, why not?
All right, mate. Well, Antler is an old mine with a rich history. Operations started here in the early 1900s. They actually found the deposit in the 1870s. And I was looking at some of the cross sections and some of the long sections in the recent New World presentations. I found it interesting. I was looking at the decline just weaving its way down and the consistency of the ore body there. And, mate, I couldn't help but think of Derek Hurd and Sandvik ground support.
He's been running that business for 20 years, mate. Let's just go to the good man himself.
Here he is. How has DSI changed under the big umbrella of Sandvik?
I better be careful what I say. Is that right? They pay the bills. One of the challenges that DSI, and I say that same by itself, had was trying to drive this automation strategy and efficiencies without the connection to equipment. So now we're part of one business. We get the opportunity to work with the underground drills team, the rock tools team, the other parts of Sandvik to work collaboratively to develop better systems for the mining houses and clients. So actually, it's really good. And one of the good examples is the resin injection systems that you've spoken about before. That now that's one of the pushes that we've had through the underground drills team to work with those guys to have a kit you can put on a jumbo. That now you can injection bolt off a jumbo. Now that wasn't around from a Sandvik perspective a couple of years ago, and certainly it's a big drive that we've been able to push through the Sandvik machine.
There we go, mate. Go Sandvik ground support.
Okay, JD, you've been noticing a growing trend. Maybe it's alarming, maybe it's abnormal, maybe it's not, but more mines are getting nationalised. What's going on?
They are, mate. There's a few things to chat about here. So I want to chat about the recent resource nationalism kind of displays we've seen. I want to also chat about why the market hates Barrick and has done so for quite some time. And then we're going to share that chat we mentioned with Tim Staermose, which I'm pretty excited about.
So you want to start by talking about Niger. How come?
There's this company, Somer. It is the uranium miner of Niger. It's a joint venture between Orano, who own 63% of it, and Sopermin, which is Niger's state-owned mining entity, who own the remaining 37%. Now, this has been operating and mining uranium since the 70s, and it churns out, for a long time, about 5% of world uranium supply, so not an insignificant amount. Now, recently, there was a bit of a step down as one of the operations, the underground mine called Cominac there ceased, and on the back of political instability, they had a military coup in 2023. We've seen that sort of step down to kind of 2 to 3% of world supply. But looking at other commodities that we've spoken about in the past couple of years, you take those sorts of amounts offline or you move it and stuff, and it can have pretty sizable effects on commodities. But if we look at specifically what's happened in Niger, they got fed up with a company that's predominantly owned by the government of their former colonial ruler, France, and they gave Orano the boot. So they're nationalising the asset, not a surprise here, particularly since the coup in 2023 in country there. The relationship has been deteriorating. Niger took control of the assets, took operating control late last year as well. They accused the French, in this case, have taken more than their fair share to justify the expropriation. And as you'd suspect, the French disagreed with that. But what can you do when the mine is where it is?
Nasty, mate. Is this as simple as just wanting a bigger slice of the pie, like ordinary resource nationalism, or is there more to it in terms of where is the uranium production going to here, and does that change?
What you can clearly see is that they have been fed up with the relationship with France. So they've lent far more into the Russian sphere of influence and partly China as well, but they've moved away from the West. You can see that with the Wagner Group, which has been all throughout the sort of Sahel, from Burkina, Niger, Central African Republic, Mali. It's a theme that's sort of spread across those countries. And, what we've also seen in a lot of those countries is military coups. So they want to keep the economics more in country. This is a theme across the world, and it's a theme kind of as old as time, and I don't think we're completely immune from it in the West here either. You can't just pin it down to one or two kind of factors. I think it's a growing trend, and I think there's contagion with this resource nationalism. I think people here in Niger will see what's happened in Guinea, Mali, and these sorts of places, and they'll realize, hey, we can get a bit more of the economics. And I don't think they're completely, out of the loop in saying that, hey, they might not have had the best deal if we go back to the 70s and beyond. So it's not completely unfounded, but it is what it is. And where it leaves the uranium market is an interesting perspective. Firstly, I think it's something that commodity traders kind of love because markets become more opaque.
Mm-hmm.
The supply isn't leaving the world market. It's still there. Costs escalate because it's not the freest and most easily kind of traded market anymore. Things are rerouted.
There's winners and losers.
Yeah, exactly. So it's kind of interesting. I do think we see a bit of tightening in the uranium market, and perhaps that has a bit of upside risk to it in time. But I don't think we should dwell too much on the point of resource nationalism, because Tim is going to share phenomenal insights on that kind of point, mate. He
made some great points as it relates to the type of strongman leaders that pop up in these types of countries and how they appeal to a crowd that promise the world. There's this kind of rinse repeat dynamic. I found that so interesting to kind of contextualize what those long-term risks are when you're playing certain parts of the world.
Absolutely. He is a wealth of knowledge, and you see it across the globe, but he's got real great insight into Africa. But my mind was sort of bouncing around, going in different directions. I was sort of starting to think about Mali, and that kind of led to me thinking a bit about Barrick and what's happened with their Lulo complex there, and, in the process of kind of having the economics rejigged. And
I'm
then
so keen to talk about Barrick, mate.
Yeah, and then what's happening in the Middle East, obviously their huge growth project is Reko Diq, which sits well less than 100 kilometers from the border of Iran in western Pakistan. So, yeah, we've got a lot to talk about here. This is a $50 billion US dollar mining company. Now, you could strongly make the argument, I think, that is too big and too many assets to manage, but we'll leave that for a moment. And the share price has just not performed well. And this is not just a 1 year phenomenon, a 2 year phenomenon. Going back a number of years, really since sort of like 2020, on the back of the big deal they did in 2019. Like there has been
Gold 2019. Yeah.
Yeah, exactly. There's been huge underperformance for a host of reasons.
Yeah.
Right. And
Production has fallen like consistently
Yep.
lower.
costs have escalated. Granted, that's been a theme across the industry, but
Issues in many parts of the world with their host countries.
yep. And they've got a lot of capital that needs to be spent going forward. And I found it particularly pertinent reading comments from Agnico Eagle's CEO just yesterday, saying the only metric you need to hit as a gold mining company or to be a valid gold mining investment is to outperform gold bullion. And
Yeah, why do you bother owning a mining company if it's not operating leverage to the gold price?
exactly. And that is the question we're going to have a crack at answering now, mate, because it's become consensus to be bearish Barrick.
I don't know if consensus to be negative Barrick, but I don't know if it's consensus to be bearish Barrick in a gold bull market.
Yeah, I'll
I
take
guess,
that. I think that's fair enough. It's not as if these people have specific, explicit short positions in
Yeah.
the stock, but
It's easy to point out that they have been drastic underperformers in a sector where you've got a huge rising tide being the
Yeah.
gold price.
Yeah, and it's easy to say nobody's going to back you for a growth project in Pakistan. That's another kind of common refrain. And, chuck in the portfolio 10 to 15% of your earnings coming from Mali, where your relationship is less than friendly as well. All these things kind of compound the discount that they are getting relative to their peers. So the capex overhang is real. They have spent a decent amount of money on Pueblo Viejo in the Dominican Republic.
Yep.
That is scaling up. They have earmarked a lot to be spent at Lumwana in Zambia.
Lumwana super pit.
Exactly. And that's their evolution to becoming more of a copper producer rather than just a gold producer. And then you've got Reko Diq. So this is the asset that they own 50% of. It's a huge copper gold story. People have known about this project for a long, long time. Barrick have had issues with the government. They finally have got to a point where they're happy and keen to invest and make this the horse they're backing, and investors are just not warming to it. So
What are the latest kind of consensus numbers around what capex is going to be in to bring Reko Diq online? Like I see kind of around that $9 billion US kind of quoted relatively frequently out of the sell side, and that's a lot of money to be spent to bring this online. Now granted, what they've got a 50% stake in it. What share would they actually be having to commit up front? Like it's still an enormous capex profile to come out of Barrick. And the weird thing about gold miners is often they don't actually make a hell of a lot of free cash flow throughout the cycle. In the good times, they make a bit, but this is a good time right now, and they're going to be reinvesting the majority of that into a part of the world that has a big question mark over it amid kind of heightened geopolitical conflict and the key risk of kind of destabilizing a region which is already pretty destabilized.
Yeah, I was flicking back through their most recent quarterly, and there were some super interesting comments from Mark Bristow, the CEO. I'll read a couple out because I think they're super relevant here. So Barrick has a distinct approach to growth, one that avoids the pitfalls of industry short-termism in favor of long-term growth, internally funded value creation. While others pursue shortcuts through M&A, we continue to invest in our own future by building and not just buying, creating real value. So it's aimed, it's kind of pointed, and it's not as if they haven't tried those other means in the past. They've done a lot of acquisitions. Their share count over the decades has increased, like many gold miners, quite substantially. It's in this point in time, the means of growth that they're choosing is to invest internally. But yeah, you can't exactly accuse them for not having a crack here, but they are getting severely discounted in the market from it. Like Agnico Eagle is the standout. That's the one that kind of gets the premium valuation. They have assets, more or less purely in tier 1 locations, and they are big operations that they can continue to invest in and see those returns from. They've done M&A well, they've executed on it. And then you have that sort of pack that trades in and around 1x NAV, and you have a big step down to where Barrick kind of currently trades, right?
That's at spot gold. You're saying that they trade less than 1x NAV, yeah?
Correct. Yes.
Yeah. I think it's going to be an interesting decade for them. I don't know how it pans out. I also think that they actually could, like, if there was if Elliott had the kahunas to do another activist campaign in a resources company, then like Barrick's a prime candidate for it in some ways.
It's an interesting one though, because a lot of the criticism from other investors about these gold companies is reserves is just diminishing, and they don't have a growth profile. And that would be the case that Elliott, I'd imagine, would make, is that cut off the cash flow that you're going to send to Reko Diq and other growth projects and focus on what you've got and just harvest the cash.
There might be, like, I think there's low hanging fruit on portfolio rationalization that you can argue for the likes of a Barrick. Do all your operations stand up on their own feet? If not, sell off the ones that don't, focus on.
Yeah, like what Newmont's done. And they've done that in part, selling Donlin. I mean, they could easily do it more. I think there's far too many assets in that portfolio.
You reckon they'll regret selling Donlin? That's an interesting question, right? One day that could be an enormous mine.
It's a super pertinent question, right? Because the exact reason why people on the other side of the table in that transaction bought the mine is because of their fears over what's happening in Mali and what perhaps could happen in future in Pakistan. Gold is the horse they're backing, and they want it to be large scale, heaps of ounces, and in a tier 1 jurisdiction.
Protected by the rule of law, as Tim Staermose will say. And I'm really, really keen to play that conversation, which we'll do now. But before we play the conversation with Tim, JD, I want to briefly tease a controversial interview that we've got coming out next month. I won't tell the money miners who the guest is. Here's a tiny snippet.
That one the other day was, what's the drill recovery? Oh, in diamond holes not applicable. I'm like, mate, you do get core loss, right? The drillers put blocks in the wrong way round. People drop trays of core and just stuff it back in, and they don't tell you. Now, are you saying that none of that ever happened in your drill program?
Now, I can't speak for the quality of the logging by the geos, but I can tell you, JD, none of that ever happens on a K-drill program. K-drill knows that sample matters. It's the slogan. It's enforced by the enforcer, Ryan O'Sullivan himself.
Here I was thinking K-drill only cared about meters, mate.
Nah, mate. They're more than just a pretty face. Productive drilling plus clean, reliable sampling you can trust.
Mate, if I was out there trying to find the next Reko Diq, trying to find the next Kamoa, trying to find the next Escondida, next Super Pit, first call would be to K-drill, mate. I'd be getting Ryan O'Sullivan on the phone stat.
You can trust their sampling, mate. Go K-drill. Okay, to the chat with Tim Staermose. Kicks off talking about Zimplats.
I actually have historically had an investment in Zimplats, which is a very good platinum mining operation in Zimbabwe that everyone runs for the hills whenever they hear Zimbabwe, but it's actually very well structured and cleverly done by the guy who set it up, and obviously
Totally.
it's a subsidiary of
87%
now.
owned by Impala. They need the
Yeah,
dividends
yeah.
upstream, so they're always going to pay out that free
Correct.
cash. And
it's
but
actually a Guernsey structured vehicle.
It is.
So
It is.
a lot of the money sort of never actually enters Zimbabwe. The mining is done there, and then it's sold, and the money is booked offshore. Obviously, the Zimbabwean government and people do quite well out of it as well. But yeah, I was actually involved in that way back as an investor prior to Implats making the takeover bid. I think it was like 2003 or something
Yeah.
like that.
So the
it's
Guernsey
been operating
structure
for a
makes
long
it.
time.
That Guernsey structure, I think, makes it a bit trickier to mandatorily take over the minority interests as well, because if it was an Australian company, you could get to 90% and then force. But I think the Guernsey structure actually makes that
Correct.
a trickier
Yeah,
proposition.
there's no compulsory acquisition in Guernsey. It was actually deliberately structured that way. There was a guy called Peter Van der Spy who was behind Delta Gold back in the day. I spoke to him at the time when I was doing the research into the company. Geez, that's a long time ago. But it's still going strong.
It's been a tremendous story if you held it for that long and you've received the dividends.
Yeah, so there's opportunities all over Africa. Ghana doing very well at the moment, also with gold. I was on a call last Friday with the brokerage firm that we work with in Ghana. They were talking about the currency having appreciated tremendously in recent months, partly on the strength of the gold exports and the foreign exchange that's bringing into the economy. The only stock we own over there is MTN Ghana, which is the main mobile telecommunications company. But when an economy is doing well, often because of some minerals exports doing well and earning them lots of foreign exchange, then the whole place starts to do better, and the kinds of businesses that we invest in also do well because consumers have more money in their pocket and there's money circulating around the economies.
I'm curious, Tim, how have you actually noticed the investability of the various African countries change over time?
Yeah, look, there's 54 countries in Africa. It's a very diverse continent, even more diverse than Asia, where I was before. But I tend to focus on economies that have common law as their foundation, which is something that I'm familiar with as an Australian, and then obviously English as the language of business. In general, where I'm focused, Tanzania, Kenya, Uganda, Nigeria, Ghana, Zambia, these are places that have a legacy of British colonialism that shaped the way that the law has developed post-independence as well, and English is still very much the language of business around the place. So that makes it quite familiar for me. Also, the way that corporations law and stock exchanges operate, they're quite similar. They're not as sophisticated as Australia, for example, although they are in certain ways. So, for example, the way we have a CHESS system and the way that shareholdings are registered electronically. One exception, oddly, is Namibia. There's still paper-based settlement there. It's very hard to get a custodian. So it's a bit odd. Namibia, I think, has a German colonial history. I don't know whether that's got anything to do with it. But in general, they're all moving steadily towards being more modernized and offering better disclosure, and things are improving.
Am I right in kind of characterizing Nigerian stock market as kind of uninvestable, say 5 years ago, and what's changed?
So Nigeria, when I started my fund back in 2020, had a very odd exchange rate mechanism where there was a peg of sorts at about 450 to the US dollar. But foreign investors that had legacy investments on the stock exchange, because there had been a boom from about 2011 all the way up to shortly before 2020 when I started the fund, and people would sell stock and want to repatriate their profits, but they couldn't because there were no dollars available at banks and custodians to change your Nigerian currency into so that you could take it home. What was actually going on was, giant corruption, really, where the scarce foreign exchange that the central bank had was being allocated to favorable or to favored parties. So there was a black market that developed, and the true exchange rate was more like 950 or 1,000, so more than double the official rate. So I took the view that it was uninvestable at that time for me as someone putting new money in, because how was I ever going to get it out? That said, I did find a way of getting money in at a much better exchange rate by buying dual listed companies. There are some dual listed Nigerian shares in London. So you could buy the shares in London at the black market exchange rate effectively, and then transfer those shares into Nigeria and sell them and get a much larger amount of local currency than you would by wiring your dollars straight in at the official pegged rate. So we tested that. We put a little bit of money in. But in subsequent years, there was a change of a regime. New president came in and, in his inauguration speech, he basically said, right, the fixed currency is gone. Currency as of tomorrow is free floating. And we've actually made money in Nigeria since then. We don't have a huge percentage of the fund in Nigeria. I think it's about 8% versus sort of 35% in Tanzania and 30% in Kenya. But at the moment, it is actually back to being on the radar and investable because of the currency convertibility problem having been fixed to a large extent. We actually have a small position in something that's gone up sixfold so far this year. That reminds me a bit of my old days investing in the right mining stocks. You can really get some big pops.
The sixfold or 1/6 in a short period of time.
Yeah, there you go.
Both are possible. So, do you tend to kind of have a bit of a sense when a country is becoming more hostile to foreign capital? We get this all the time in mining where regime change comes and all of a sudden the conditions are far more onerous and hostile on the existing mines. The government wants to expropriate a larger percentage of the pie and you kind of have to say yes. Otherwise, face a very lengthy kind of arbitration process and that deters foreign capital. Can you see those sort of symptoms coming before they do?
Tough question. It is a pattern across Africa. And if you step back and look at the reasons why, institutions tend to be quite weak and the culture tends to be based on personalities and strong leaders. And I guess it's a function of the tribal nature of a lot of the societies in these countries. Although in other parts of the world, that was also the case, but a lot further back in history. So generally what you'll find is even a president from the same political party taking over from his or her predecessor might have completely different policies because it's based on that person and the kind of people who follow them. So yes, if you're a mining company that wants to develop a great ore body over a period of decades, you do have that problem because you do a deal with whoever's in power and everyone's happy. The regime changes, whether it be a new political party coming in or a new strongman or even a person from the same political party. As in Tanzania, the same political party has been in power ever since independence, like over 60 years. But the personality that comes in and occupies the seat will have a different view on things. They'll have different hangers on that they have to keep happy and whatever. So there's always that danger that the rules of the game change. And I don't really see anywhere where that doesn't apply or where it's going to get all cleaned up and made predictable anytime soon. Maybe a place like Botswana is a little bit easier to operate in than a lot of other countries where the institutions seem a little bit stronger and rules are followed more regularly. So I guess, as a shareholder, you just have to face the fact that there is that risk, and it's something that the company that you've invested in also needs to be cognizant of and know how to manage.
One observation I have of a lot of the mining companies that operate in Africa is a tendency to maybe try and minimize the payable tax by using interesting structures or transfer pricing mechanisms to avoid what would otherwise be a pretty onerous tax regime imposed by the local country. Do you have any observations on that strategy amongst the pool of companies that you actually invest in? Is it typically just an avoided strategy because you pay the piper even more down the track, or what?
That's a very good topic. This is a very complex topic. And yes, the knock on natural resources companies, which are seen as more extractive and exploitative by everyone. But it also applies to multinational consumer companies that of the type that we invest in. It's definitely an issue. A typical structure that companies that we own will have is a multinational controlling shareholder that might have between 60 and 75% ownership of the local company. And then the remaining third or 1/4 of the shares will be in the hands of local institutional investors, pension funds, high net worth people living locally, foreign funds like mine. And if the multinational company is a good corporate citizen and pays its obligations and avoids any sort of egregious transfer pricing strategies, then everything's hunky-dory. And often the governments recognize that these companies are very good employers and they're in the formal sector They all pay their tax obligations. Their employees are in the system and on the books as pay-as-you-go taxpayers, and they're compliant with VAT and other taxes. So the government does very well by having those kinds of companies operating in their countries. There are instances, however, where the multinationals try and push it too far, and there are, in fact, a couple of companies that we're invested in now where we're starting to see things that we don't particularly like. So we need to raise it with managements. But it's not unique to mining and natural resources. When you're selling a product locally to local consumers, I guess it's a little bit different from when you're just taking it and putting it on a boat and then sending it overseas and booking all the profits offshore and not leaving much behind. So I think that's where sometimes the mining industry gets a bit of a bad rap.
I'm keen to get your thoughts on a couple of different other up-and-coming or established mining investment jurisdictions at the moment. And I understand there might be a different lens you'd apply to a foreign mining company building a mine in X country versus you investing in an industrials company listed on that country's stock exchange. But just curious to understand your take on the investability of a few different African jurisdictions at the moment. Start with Kenya.
Kenya does not, in general, have a lot of natural resources. So I think the government in Kenya, maybe they weren't as focused on extractive industries, frameworks and laws and so on, but it was definitely possible for them to operate there. And I don't think they had any huge challenges. Next door in Uganda, I think the regime is quite favorably inclined towards mining and oil and gas projects. There's a huge East African oil pipeline that's running from Uganda down through Tanzania to the coast at Tanga. The problem they've had is sort of climate change activists not wanting Western banks or financial institutions to fund it. But Uganda, it seems quite favorable, and their currency has been quite stable because of the anticipation of this FX that's going to come in. It's also a big agricultural exporter. DRC remains, like the Wild West. A lot of people making a lot of money there. Sadly, a lot of it in sketchy fashion. Zambia is a jurisdiction that's very pro-mining. It's had other issues with a drought and currency weakness because of a debt default. They borrowed a lot of money from the Chinese that they couldn't pay back about a decade ago, and they've been trying to work through that. Ghana remains a very favorable jurisdiction for mining. I think there are a lot of Australian companies operating over there. Botswana remains a good jurisdiction in which to operate as far as I am concerned. Zimbabwe, as I said, I have a history with Zimplats. There are one or two gold companies that are doing quite well. Just the currency problems in Zimbabwe make it uninvestable for us. It's just too hard because they still haven't got their currency into any kind of pattern where it doesn't sort of devalue by 1,000% every year. They adopted the dollar. The latest is that they've got a new thing called the ZiG, which is the Zimbabwean gold. So it's supposedly pegged to gold, and that's not working either. So, the place does still function. And as Zimplats proves, you can find ways of getting through it.
What are the most underrated frontier markets that the general population has kind of ruled off, but you can see them as on the rise or improving governance, improving rule of law, etc.?
So, of the top 10 fastest growing economies in the world at the moment, I think 6 or 7 are in, my university in Africa. And it's really just not something that the rest of the world is focused on. And I guess it takes a while for biases to change and for the word to get out and things to improve the perception of the risks and so on. It's still much riskier investing in most of these markets, but you get paid very well to take on that risk. Like you get more than compensated for those risks. That's kind of the thesis that I have. But there are countries that are really making an effort to clean up their act and become, beacons of good governance and that sort of thing. A lot of people cite Rwanda as an example of that. They're really serious about becoming the Singapore of Asia, as they call it. So you go to Kigali and the streets are spotless. There's rules and regulations and order, and a lot of countries are trying to clean things up. But at the same time, frontier markets are very fragile. There are laws and rules and regulations on the books that aren't necessarily followed. And part of the skill of doing business and investing here is working how to meander through the system that way. Tanzania is an odd country because it has a socialist history, but it's certainly been one that's done very well for me, largely as a result of me going in when it was at a cyclical low. And then a change of regime that was more foreign investment friendly and improvements happening in that regard. I am cautiously optimistic on the long-term future of a place like Namibia. They've made some very significant offshore oil discoveries.
Yep.
If the government can get that right, I think it's Total that has said that they are probably going to go ahead with theirs. Even in a place like Nigeria, they've taken some very hard economic decisions, swallowed some bitter medicine, and things hopefully can improve because of that. They've sort of got 30% inflation at the moment, but they've liberalized the exchange rate. They've recognized that they need to get on top of the theft of oil, get people investing back in the oil industry there. So everyone always thinks I'm crazy investing in Nigeria and going there frequently, but it's actually one of the places that I'm most excited and bullish about. It's got a certain energy and there's a huge entrepreneurial culture, and actually quite enjoy going to Lagos. You know, it can go either way. There are places where you go into hyperinflation, and Malawi is an example of that recently. You know, a small, very poor country down to the southwest of Tanzania. But there were a few interesting businesses there that I did look at. I never ended up investing. But
The uranium restart project out that way.
yeah, there's a few Aussie companies active there as well. I think there's
Sovereign
some
metals, the
rare earths.
retail. Yeah.
Yeah, I sort of heard mixed things about uranium while we're on the topic. You know, because of national security concerns, you know, the CIA doesn't want anyone taking uranium from Malawi out to the western ports. They want it to come through, you know, say Kenya, where they have more influence. But yeah, there's all these factors that you have to take into consideration when you're looking at resources in Africa. Things are distributed and landlocked countries, and you know, the product has to traverse a lot of other countries before it actually gets out to the ocean and gets shipped off. So that was interesting. But we went off on a tangent there a bit. So what I was saying is it's sort of gone into hyperinflation, but the stock market's actually done very well because there's a lot of people that will go into shares as a way of trying to preserve their wealth, if that makes sense. And the same in Zimbabwe. You know, if you own a productive hard asset with your paper money, it tends to hold its value. And I think there's been a little bit of that phenomenon going on in a place like Malawi, also in Zambia to some extent, and obviously Zimbabwe since way back. You know, you buy land or you can buy a listed company that owns land, and yeah, that's going to serve as an inflation hedge to some degree.
You never hear much good about Burkina Faso. Some wonderful gold mines there, but just seems very tough.
So the whole Sahel region, for whatever reason, seems to be very fragile. Obviously, there's problems with, you know, just the quality of agricultural land there, not being able to support populations, and, you know, desertification. And I guess that's given rise to these sort of strongmen rulers that rise up and promise that they're going to fix everything for people, and, you know, they gain popularity for a while they get given a few years to, you know, deliver the goods, and then they never end up doing so. So it's not a country that I've visited or am particularly familiar with, but I think, you know, between a gold mine, you know, with 2 grams a ton in Ghana and one with 20 grams a ton in Burkina Faso, you're probably still going to go for the one in Ghana just because of the political risks.
That's the
It seems to be the pattern. Seems to be the pattern, doesn't it?
Yeah. Well, that's the big takeaway. Just coming to understand your approach. Every return has got a degree of risk you're willing to accept to try and get that return.
Yeah, you've either got geological risk or you've got green tape, red tape, and that sort of risk. And for me, when I invest, basically my mandate is to try and buy companies that I think can double their sales and profits in 5 years, and then buy them at valuations I think are low enough that they can also double. So if I get both of those things right with a stock, then it's got the potential to go 4x in 5 years. Now, I'm obviously not going to get that with everyone, but if I get enough of them and I don't have too many disasters, then we should be able to deliver on our target, which is to sort of double people's money every 5 years. So that's what, 14.7% compound or something like that. And we're actually on target. We've been running the fund for between 4.5 and 5 years now. And up until the end of April, we were compounding at 15.2%. That's in US dollar terms after all expenses. And we've just had a huge month in May. I think the fund was up about 8%. So we've actually vaulted well above that rate of compound return that we need to keep our fund on target to meet what we indicated investors should expect if things all go right. But that's basically my hurdle. I'm looking for at least 15% return on investment in hard currency for anything that I invest in. And to generate a hard currency return of 15%, you typically need to earn several percentage points above that in local currency terms, because there is the tendency for these currencies in frontier markets to depreciate quite significantly as time goes by. But even then, yeah, you can't put them all in the same bucket. There are countries that are better governed and have much lower inflation rates, and currencies that tend to be a bit stronger. So in Tanzania, inflation's never been above 5% in the time I've been living there. Kenya has some debt issues. The government there is pretty indebted, but the inflation rate there has also never spiraled out of control the way it has in places like Malawi and Nigeria. So when you're investing in mining stocks, probably you want a slightly higher return than 15%, just because there's extra risks. I mean, I'm buying big, well-known companies that are dominant in their industries in these markets. So typically I'll own the biggest beer company, the biggest mobile phone company, the biggest bank, as long as the valuations are right. Like, I'm not just buying those things blindly. I'm just buying them when I think everything stacks up. But it's far less likely for an African frontier government to come in and try and meddle in the affairs of, say, Tanzania breweries, which controls 75% of the beer industry in Tanzania. Whereas if you're a foreign company operating a gold mine, then you've got a bit of a target painted on your back in some respects. I don't know what your audience is looking for with their mining investment returns, but if it were me, I think I'd be looking for somewhere in the 20 to 30% range for a hurdle, which is not easy. But risks are everywhere, even in developed markets nowadays. So maybe they've come more towards my end of the spectrum.
Maybe they have.
That's the way I look at it.
Really appreciate that. Thanks for coming on.
No worries.
All right, mate, that was fantastic. I hope the Money Miners enjoyed that one as much as I did. A big thank you to Mineral Mining Services, Grounded, Sandvik Ground Support, K-Drill and Cross Boundary Energy.
Hooroo.
Hooroo.
Now remember, I'm an idiot, JD's an idiot. If you thought any of this was anything other than entertainment, you're an idiot and you need to read out a disclaimer.